So let's get into June CPI. The print released this week showed the sizable drop that anyone who's been following the oil markets, WTI, et cetera, and the rolling over since basic that's been underway since May into June. Um, Basically, this should be the least surprising uh, CPI decline I think we've seen going back to June of 2022 when we saw the oil spike, similar situation. Um, Almost like within a week, like I think it was February 22nd of 2022, within plus or minus a few days there, that the Russia and Ukraine escalation took place. Oil markets, same thing we saw with Epic Fury, shot up in response. But within 4 or 5 months, we saw that rollover effect take place. That's what we saw this month in the CPI. You can see it there, the last bar on the graph. That orange shaded section, that's your energy commodities rolling over. But then you see the other areas, food, core goods, core services. They're all tiny little slivers as well. What this is indicating is, at least for the month of June, there's a lot of slack purchasing power in the U.S. economy. We will see if this trend continues to take hold. But I the volatility or the uncertainty that I see is potentially like within the energy markets, or more specifically, the what you hear us talk about with the basically the open heart surgery taking place on the global economy, right? Rewiring where all of the supply demand connections take place between different markets, nation states, et cetera. There's still a lot to go down, I think, in the near term. Obviously, we've had Venezuela in January, moved to Iran and the Persian Gulf starting in February, and kind of an open-ended piece of business. We're still waiting to resolve. This may take a longer time than many of us think, but we could easily see other fronts open up, for example, Mexico or Cuba, et cetera, in that pathway. So there is potentially still a lot of volatility involved ahead in that process. Um, but if you just look at this chart, what we're looking at here, you think about the new Warsh Fed. He's going to be leading his second meeting in a couple of weeks at the end of July. He's made it very clear. He's coming out guns blazing, essentially, like we're going after this 2% objective. We are not going to cede that ground. And if you actually look at the task in front of them right now, if oil has in fact rolled over here after that initial, call it surprise, panic, whatever you want to call it, February 27th with Epic Fury opening, really the next uh, key battlefront for moving inflation down towards that 2% objective, or at least printing a number that the public can believe is aligned with that 2% objective, is addressing the housing cost issue. So I've got the line items that make up the CPI index that relate to housing, kind of boxed in green. And if you go further back, you can see it's like owner's equivalent rent, rent to primary residence, lodging away from home, all the stuff involved with shelter, essentially, are core, like just persistent, stubborn, um, just sources of sticky prices, right? So addressing the housing costs issue is front and center. It's now moved to the top of the board for the Fed. You can't get like the worst Fed can't accomplish that 2% objective without doing something to address housing costs and the imbalances that exist between the younger entrants, late millennials, Gen Z, et cetera, who feel priced out of that market, and then your older end of the American population sitting in a house, their situation stable, all of that. So finding balance in the housing market, I think, is moving front and center. Like we've talked a lot about the Fannie Mae, the exiting from conservatorship, all that stuff that is a priority of this administration and has been since day one. It seems like that issue's time to come to the top of the line items or priorities. It's nigh. If it's not here right now, it's coming soon. All right. So what we're seeing in the bond markets in response to the CPI coming down, we've talked about the other central banks, so mainly the ECB, but there's a few other ones who are hiking as well. But that hiking in the money markets is creating pressure on the front end. If you take the view that basically just a very simple framework for understanding interest rates. There's a real rates component, and then there's an expected inflation component. Add those two together, and you get yield. Obviously, what we're seeing here with the CPI rolling over, with break even interest rates, you use the tips market to extrapolate these numbers. But what we're seeing is declining break even inflation expectations, and specifically on the 2 year is what I'm focused on. That coincides, if you follow these plots. This is the CPI change month over month, and I just multiply it by 12 to get a kind of a yearly baseline number. They zig and zag together. You can see the last time, basically June of 2022, when we saw the commodity markets, copper, oil, they all rolled over. That's when the CPI impulse, if you remember, like April of 2022,
Yep.
the annualized like year over year prints were showing like a 9% roughly in the United States. Once the oil markets rolled over, then we kind of got past the big hump of that impulse, and we were on the way down. It looks to me like that same effect might be in play for at least the U.S. dollar and the U.S. Treasury yield curve. What's actually happening here is rest of the world, the other regional spheres, mainly the eurozone and the ECB, are in response to all those like open heart surgery. We're connecting different production and consumption centers in the global trade business franchise. And Europe's response to that is to tighten money markets. That's causing upward pressure on yields everywhere as capital tries to flow towards its best return. And what that's actually doing is it's causing a rise in real rates on the front end of the yield curve. That actually has an impact on the entire yield curve. It's actually helping, suppress or put a lid on the longer term interest rates across sovereign debt yield curves. This effect like would hold, it would hold in the eurozone. For example, we saw with the German Bund auction last week, the lack of supply, the tightening on the front end. It's drawing capital into the money markets, like the shortest risk, lowest risk, shortest duration area of your yield curve. It's building up savings and ultimately keeping a lid from the longer term end of the sovereign yield curves, as everybody's in this situation where there's too much debt and not enough collateral, as Tom Luongo puts it, or real economic activity within these economies to keep a lid or to keep yields lower. So
Sure.
this effect where we're letting the front end rise, the U.S. is going to, this isn't a rise in response to expected inflation expectations. It's basically the U.S. Treasury yield curve needs to rise on the front end because of what the rest of the world is doing, like other major players, mainly the ECB, Christine Lagarde. And that effect is actually, if you see the green line here, it is keeping longer term yields flat, potentially down, right? And so then if you look at I've got the real rates then on the plus or minus the green and red line. And you can see like in 2026, and especially in the second quarter, you can see the real rates on the 2 year inching back up. So this is attracting capital into the bond markets, and it's building confidence, at least temporarily. This for as long as the tightness goes on, the tightening goes on for a major G3 central bank. And talk about the G3 currencies. The group is the U.S. dollar, the euro, and the Japanese yen. The BOJ has been tightening for 3 or 4 years now. We know that, right? Now we've got the ECB tightening as well. This is where all the talk of, is the Fed going to have to hike rates this year? it makes no sense right now for the Fed to hike. There's not an inflation issue. Like we'll have to wait and see. It'll take another supply shock to energy markets on par with what we saw from Epic Fury. It will have to be another one of those if you think about it, because Epic Fury, the race for musical chairs to get a hold of a tanker after after supply couldn't find its way out into the Indian Ocean from the Persian Gulf. It'll take something along that order of magnitude to create another oil, run up and create another CPI impulse that the worst Fed would have to address. So it seems tough. Nothing's impossible, but it's
Right.
it's difficult to imagine something bigger than what's been sold for my entire life. The doomsday scenario allegedly in oil markets was the closure of the Strait of Hormuz. We just went through it, and it's kind of like, all right, when's the pain going to hit?
Right.
So
Yeah.
I guess we'll wait and see. Maybe it can, but it from the market signals, it doesn't look like that's the case. All right. So that's the background and interest rates. Cameron, if we can go to the next slide. That effect is actually like it's working in parallel. Like it's a tailwind to what is now the front and center issue, I think, for this administration, along with the Treasury, along with the Fed, and that is figuring out the housing market. So what we're kind of seeing in the housing market, if you're just following the news, this is CNBC, which tells you where the man on the street is in terms of his own sentiment, where public consensus is on the housing market. It's not great. We've got pending home sales for June, uh, down 5.4% from May. Home builder sentiment, I don't have this chart, I don't think, but it's been bad. Like since that June 2022 rollover in CPI, we talked about oil, copper, et cetera. Um, the National Association of Home Builders (NAHB) does a survey, and it's a diffusion index. Above 50 is confidence, below 50 is pessimism for the business owners involved in the home builder industry. They put up a 34, which this is all a relative number, but it's just like, yeah, they're pessimistic.
Right.
And that
Yeah.
that index has been pessimistic for all but 6 months since June of 2022. And it's been on a run of they've been pessimistic for like 15 months now, something like that. So you've got a market right now. It's just like something has to change, right? And it doesn't mean 2008 is going to happen. It could just mean what it actually means is figuring out how to make the math work, get home prices right, and interest borrowing costs right to get the monthly mortgage payment to a number that your younger American home buyer can afford. Right. So you need a checklist of things to go right. You need jobs, and the NFP numbers, non farm payrolls, they've been fine. Wage growth, fine. Um, Interest rates are really the last shoe to drop in my mind. So that whole effect, everything we're seeing on the yield curve, the rising on the front end, the pressure created because the check has been passed to Christine Lagarde. She's been forced to hike rates. We'll wait and see what happens here. But if we can get the 10-year down, if we can get fixed rate mortgage costs down, you see here the article, the third bullet point there says the national average on the 30-year fixed mortgage rate is about 6.64%. It was 8%, believe it or not, 2 to 3 years ago. So there's further progress to be made, but yeah, there's like it's the next item on the docket. So this is the area to watch. Aside from we'll talk about the midterm elections a little bit, other items on the administration's plate, but from an economic standpoint, financial system standpoint, this 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 is the pressing issue, in my opinion.